Morning, everyone. Welcome to this morning's edition of the NBC Markets Morning Call, 13th of May, 2026. In terms of the US, chip stocks wobbled overnight, but look, coming off an incredible run. There's probably, there's a fair bit of media coverage around them pulling back. They did recover into the close. However, they were down significantly more. But at the end of the day, we're up 150% on the year. 4% pullback's not much. In terms of our market, everyone's focused on the budget, hence why we're a little bit late this morning. Let's just quickly cover the US market. There's that chip stocks in the bottom left-hand corner there. And you can see that they've pulled back a little bit. Obviously, Oracle and Tesla in the middle there, and Broadcom in the middle as well, pulling back. Because Tesla's kind of included in that chip with the terafab and things like that, and the Intel investment, etc. ServiceNow, CRM, you won't be able to see them there, but they're just those red squares just above and to the right of Meta. They got pretty hit as well. ServiceNow, and they're sort of at that front line of that SaaS apocalypse. But yeah, I thought might start to turn around. The narratives might start to turn around, but we're not done. We're not done yet. It has in some stocks, but not in others. ASX was down yesterday. Obviously, concerns in this budget. I'm not going to go into too much depth with that. We will have a quick interview with an accountant at some stage over the next sort of 24 hours and go through pluses and minuses for investors. But I mean, very broad. Definitely not tax advice, but obviously concerns around policy there, and setting our market lower. And look, we're fairly benign overall. Gold, silver, copper, platinum. They're silver, copper, and platinum still doing very well for the week. Crude's now up 6%. That's weighing on equity markets as well. Obviously, that CPI number in the States. The core number, stripping out basically everything we use, was still 2.8, which is high for the US. I believe it was something around, core was 2.8 year on year, 3.8 year on year in the headline, the highest since May 2023, above the 3.7 estimate. Bond yields have rocketed as well. This thing at record highs. If these chip stocks start to fall away, I'm sorry to say this thing's probably pretty cooked, because we had Nvidia and the AI hyperscalers hold up the market last year. The SOX is holding up the market kind of this year, but there's only so much you can ignore fundamentals. Trump's in China meeting President Xi, so we'll expect a bunch of announcements that Xi's not agreed to from Trump over the course of the next. Over the next 12 hours, and then he'll say that they're friends and blah, blah, blah. He says Iran's not even on the trade is the priority, not Iran. And he's already said my relationship with President Xi is a fantastic one. First presidential visit to China since 2017. We'll see what level of complete baloney comes out of that visit. Generally, in these scenarios, we only really trust the stuff that's verified by the Chinese, which is a weird place to be, I've got to say. I'd rather be trusting the Western leader, but as we've seen with the whole Iran thing, the guy basically doesn't tell the full truth at least 81% of the time. So. Corporate and AI and things like that. Anthropic's doing a 30 bill raising and a 900 bill valuation. I think that's lower than what these other guys have marked up at. They got those earnings up, so I don't think that helps the market either. Google's in talks with SpaceX to launch orbital data centers. So Elon's crazy data centers in space idea is clearly not just a crazy idea. And I think one of the Under Armour, which is one of the fashion sports brands, active brands, got hit, which does not surprise me in the slightest, given weakening consumer dollar, and maybe you just wear an old T-shirt and to the gym instead of an Under Armour T-shirt. So look, here we've just got official verdict and who gets hit the hardest. So new share ETF investors post budget, they're probably, well, this is it's a matter of opinion on who you are, whether you're worst off or not. So just please no hate mail on who's the worst off. So I would just probably classify these as major hits, but discretionary trust holders and businesses, established property buyers post budget are going to get a major hit just because of the negative gearing has been abolished for residential property. So still in shares. So that's a good thing. But, holding passive ETF strategies is where, because we're share focused, that's why we put worst off at the top there. But the changes to the CGT thing now really hit passive ETF holders the most. Because you basically had an underlying bid due to the tax policy that really benefited that policy, and now you're probably leaning towards that not being the most optimum strategy. It's not just so that I would expect there to be a fair bit of manoeuvring, and that's what I say. We're going to interview an accountant, and we're going to have a talk to many of our accountant referral partners over the coming days, and then probably put out a little 10-minute thing for everyone just on stuff related to the share market. But if there's ever been a time for a portfolio review to be reviewing what effects this has, and we've certainly found that the structured investments that we do that package them up and things like that use options, not leverage, that where it controls your capital gains tax events and things, was not the aim of when we formulated and constructed these products, but it certainly has benefited. So existing property investors are only partially sort of hit, moderate hit, high balance super, which kind of knew that. New things to come out of it, seniors who are 65 plus, their private health goes up, which I think's that's pretty crappy. I've got to say, that this is why we're all forced to have a private health insurance, was to stop this, and then they're charging anyway. I think that's a pretty poor policy, but they've got to. Obviously, the hospitals are underfunded, so they're trying to go at it somewhere. But yeah, it's. I mean, this is a controversial budget. I reckon I've cared about the budget once in the last 20 odd years in financial markets. Renters and first home buyers, it's very mixed. Beneficiaries, workers and small businesses, there are some concessions in there for certain things. The tax break was just piecemeal. It's pretty pathetic, to be brutally honest. And novated lease users for electric vehicles, that was a bit bewildering, but that's probably going to hit the likes of those novated lease companies like I think Smart Group and stuff like that. May see a bit of a hit today on the ASX. So buy the dip. Today's your last day to put in your interest. Scan the code. There is a tax wrapper on this investment, which did survive last night because the investment's classified as prepaid interest. There is an ATO ruling, so there is a tax deduction within this as well. We weren't marketing that at all, and it's not a reason to do the investment. The investment on its own is actually, it's good enough to do without that, but it's just a nice little bonus and added kicker. And we sort of confirmed that it survived via the budget last night. If that was the selling point, we would have obviously closed the deal earlier. So it closes this Friday, but expressions of interest close today at 5 o'clock. So you can go to mpcmarkets.com.au/enhanced-growth, or you can scan that code. But today's the last day for you to be able to register your interest. It's a very good strategy overall, in my opinion. So have a look at it, and it's available to retail and wholesale investors. For those of you holding those index ETFs in Australia, after this budget, this becomes, this potentially, depending on what your strategy is, becomes more, you maybe be more incentivized to do this if you were thinking about switching out anyway. So it buys the dip, it buys the S&P 500 index. there's an underlying volatility index that it buys, but your entry point is over an observation period of 6 months, and it observes every Tuesday at settlement price in that product. So if the market dips, you actually do capture the dip. So if you want to take profits in ETFs now, then and attempt to buy the dip over the next 6 months, this is what this is built for. So we've specifically made this for our clients, and who are happy to sit in cash, but this is a good way to deploy the cash and use it for some leverage and etc. So really good product. Scan the code. We'll send you the PDS, but you need to do it today. And for those regular morning call watchers, this is the last time you have to hear me pitch it. But people, have a good day out there. We'll have probably a bit of a special edition on the budget. I just need to confirm a few things, and hopefully we'll have something out in the next 24 hours from an investing tilt. Have a great day, and we will speak again tomorrow.
Feeling lost with investing? Meet Mosaic. Mosaic is MPC Markets' platform that turns confusing markets into clear, actionable guidance for your portfolio. Discover Mosaic today. Portfolio and trade ideas in one place for clients and subscribers, powered by MPC Markets.